So what happens when a company reports an absolutely record-breaking quarter? Hits every single metric out of the park, and Wall Street just tanks the stock. Well, that's the bizarre paradox Duolingo just handed us with its Q4 earnings. The results looked incredible, but the market's reaction? A swift, punishing sell-off. We're going to unpack this disconnect between stellar performance and a stock in what looked like a free fall.
And this slide right here lays out the conflict perfectly. On one side, you've got the beat, phenomenal results that blew past all expectations. And on the other, you see the market's reaction, a massive sell-off that just vaporized billions in value. This is the kind of thing that makes investors scratch their heads, so let's get right into the numbers.
Okay, by any traditional measure, this was a flawless quarter. I mean, look at this. Revenues soared to a record $282.9 million. That's a 35% jump year over year. Adjusted earnings per share, a solid beat. And daily active users hit an all-time high. This is the exact profile of a hyper-growth company that is just executing perfectly.
And yet, this was the market's verdict, a brutal 23% plunge in after-hour trading. This wasn't some slow decline. This was an instant algorithm-driven shock. So it really begs the question, what in the world did the market see that wasn't reflected in those fantastic historical numbers?
Well, the answer, and this is the key to the whole story, it has nothing to do with the past. It's all about the future. The sell-off was triggered by one single thing, a guidance shock that completely reset Wall Street's expectations for where this company is headed.
Let's be crystal clear on this. The market wasn't punishing Duolingo for its Q4 performance. It was reacting to the company's forecast for the year ahead. You see, for these high-growth stocks, forward guidance often matters way more than recent history. And Duolingo's forecast, well, it was like a bucket of ice water on all that investor enthusiasm.
Okay, here's part one of the shock. The company guided for 2026 bookings. That's basically the total value of contracts they expect to sign to grow just 10 to 12%. Now compare that to the nearly 30% growth they've been posting. You can see that is a massive, massive deceleration. For a company that's priced for hyper growth, that kind of guidance is a huge red flag.
And then came the second blow, profitability. Duolingo announced their adjusted EBITDA margins, which is just a measure of their operational profitability, would compress from nearly 30% all the way down to around 25%. Now you got to understand, when an algorithmic trading system sees slowing growth and shrinking margins at the same time, it doesn't wait around for an explanation. It just sells.
But, and this is a big but, if you look past the automated selling and actually listen to what management is saying, a whole different story emerges. They're saying this isn't an operational failure. This is an intentional, strategic move. They are deliberately sacrificing these short-term metrics for what they believe is a much, much bigger long-term prize.
So let's talk about that strategy. What management is doing here is a classic scale over profits pivot. They're intentionally hitting the brakes on near-term financial growth so they can aggressively go after user scale and really fortify their competitive position for the long haul. And the plan has 4 pretty clear steps. First, they're going to reinvest potential revenue right back into the platform. Second, they're going to enhance the free version to make it so good people can't resist. Third, they're expanding aggressively into new areas like math and music. And the ultimate goal of all this? Forge a clear path to 100 million daily active users. And to put a number on it, we're talking about over $50 million in potential bookings being plowed directly back into the free user experience. They're basically taking features people would have paid for and moving them to the free tier, all to make the platform stickier and more valuable than any competitor out there.
The core strategy here is all about widening their economic moat. Think of it like a castle's moat. It's what protects you. In an age where you've got these formidable AI competitors popping up, Duolingo's plan is to make its fun, gamified platform so dominant that it becomes the default choice, effectively building a wall around its business and locking out the competition. They're sacrificing today's profits to own tomorrow's market.
Now look, talk is cheap, right? But management is backing up this whole strategic pivot with a massive financial commitment. This is their way of signaling to the market that they believe in this long-term plan, even if Wall Street is panicking in the short term. And here is the proof. Right alongside that weak guidance, the board authorized a $400 million share repurchase program. This is management sending a crystal clear signal. It's them saying, you think our stock is worth 23% less today? We fundamentally disagree, and we are betting hundreds of millions of our own capital on it.
And they absolutely have the firepower to do it. The company is sitting on over $1 billion in cash and generated nearly $94 million in free cash flow this quarter alone. That's real cash from their operations. So they're not just funding this pivot, they have a war chest to buy back their own stock at a discount while they do it.
So this all brings us to the core of the issue, right? The situation here presents a really clear dilemma for any investor, and the right way to think about it depends entirely on your time horizon.
You can really look at Duolingo through two very different lenses right now. The short-term view, say the next 3 to 6 months, it's pretty cloudy with uncertainty and those slowing numbers. The long-term view, though, thinking 3 to 5 years out, well, that could see this moment as the foundation for a much larger, more dominant company.
So the investment thesis really boils down to this balance. On one side, you have these very clear short-term risks, slower bookings, compressed margins, and guaranteed volatility. But you're weighing that against the potential long-term reward that management is shooting for, a wider economic moat, a true platform monopoly, and a massive user base that they can monetize for years and years to come. Which leaves us with the ultimate question you have to answer for yourself as an investor. After seeing all this, is this 23% drop a sign of a fatal flaw in the company's business model as it faces new competition, or is it just the temporary price for a genius strategic pivot that's going to create enormous value down the road? The answer to that is what will define Duolingo's next chapter.